Okay, welcome to the first video on the strategies or the usage of the Sierrachart Ninjatrader study pack. So in the first video, I'm going to go with something very simple, but on the other hand, something that is going to answer most of the questions about things like execution, risk, reward, so stop losses and stuff like this. And obviously there is not going to be one universal answer for how to approach this. Everything I'm going to show you in this and upcoming videos is I guess my take on this approach, and also or my kind of approach to exploiting these studies. So the first thing is obviously the study itself. So this is on the screen. We have only this one ET options trading plan, right? With the other stuff, which is not that important here. The study itself is based on these levels, and I explained where these levels come from, and this one sentiment bias from the dealers. Okay, this is going to be an explanation of the very basic approach to this study, and then we'll go through some numbers and why I think which will be kind of evidence of why I think that this is actually a very viable way to approach this study. So the idea is, to get the process simplified, is that we want to have, first of all, the direction in which we want to trade. So this is basically either green or red, right? We don't trade in this basic strategy. We don't trade against this sentiment. If it's green, we are going to trade long. That's what we know for sure, that if we are going to trade, we are going to trade long. If it's red, we know that, okay, we will want to trade in the direction of short side, right? And we get this from this first dealer's bias, which is either bullish and then it's green, or bearish and then it's red, and it's on the upper side of the levels. Okay. Now the second part is answering the question when. As you can see, we have two time windows, I call it, right? So the first one is here, and the second one is here. All right, so this is European session from 9 to 12. It's 9 to 12 Central European time, so it's going to be New York time. It's going to be from 3 a.m. until 6 a.m. And then there is the regular US session, 9:30 until 12, right? So these are our two potential trade windows. If we are going to trade with this direction, we want to trade either here or here. And in this particular video, I'm going to talk about trading the second window, because the first window is a bit more tricky. And I will explain this in the next video about some more advanced, I'd call it a bit more advanced technique of exploiting this study. But to simplify things, I'm going to show you in this part, I'm going to show you the RTH session. So trade window number 2. Okay. And what would be the basic approach to entry, to exit the position? Okay. Okay, so one thing that we have to introduce into this analysis is the risk unit, and I talked about it. I talked about it in a previous video. A risk unit is this distance between two closest lines, and as you can see, the distance between each of these dotted lines is the same. Right? The distance, these are equally distant, and the smallest distance here, so in this case it's about 5 points, is our basic unit of risk. So when I'm going to talk that, okay, I'm risking 3 units, you know that I'm going to risk about 15 points, right? Because the distance between, if you add 1, 2, 3, these 3 same distant units is going to be about 15, probably closer to 13 and a half in this case, something like that. So this is, for every strategy, this is very important to have this well defined. Like the risk and potential reward has to be well defined. Okay, so what is the basic strategy? The basic strategy has only one goal. The execution has only one goal: to enter at the very beginning of the time window or trade window number 2. So during this period, you want to enter the market as soon as it opens. So usually what I do, so this is the part about executing or entering the trade. So usually what I would do, and this is actually what I am doing every day. Okay, so about 10 seconds before the market opens, closer, maybe 5, 4, 3 seconds before market opens, you can see that the volume picks up. It already picks up. The market is starting to get a bit nervous. The volatility jumps, and this is when I just click to buy or sell. So I'm opening at the very open of the market. I want to be as close as the open of the market. Right. So in this case, so let's close a bit, zoom in here. All right. So we know that we want to buy, right? Because it's green. The dealer's sentiment is bullish. We want to buy. This is the open price. Okay. This is open. So probably somewhere here, like just a couple seconds before market opens, I wanna go in, right? And I want to go in long. Okay. Now, why don't I use the optimal places to enter the trade? So what are the optimal places to enter the trade? Well, usually this is this line. So if market opens somewhere here above, somewhere above the this yellow line, this pivotal green line, if it opens above this, you would say that, okay, if it opened above this line, the optimal entry would be here, right? But again, this is not the basic strategy. In the later videos, I will show you how you could make it even more reliable in sense of the relation between the number of losers to number of winners. But for me, right now at least, based on the stats, it's even simpler than that. I want to trade almost every day with this strategy, okay? Because I'm so confident and convinced that the edge is there. So as soon as the market opens, I want to be in the market, okay? In this basic strategy. And it really doesn't matter to me where I am in relation to these levels. If I'm above, the long zone or below it, if I'm above the target zone, I don't care. And I will show you why I don't care about it. Now, once you get in, you need to find optimal stop loss, obviously. Okay, so now I will show you a stat which is based on this basic entry. So entry which is based on the market open, and how many risk units, so how many of these distances the market usually falls down in case of bullish sentiment, or goes up when we are talking about bearish trade. So what is the maximum drawdown during these trades in these time windows? Okay, so I'm not going to show you the drawdowns during the periods when it's after the 12. Okay, so during this period, this trade window number 2, what is the average drawdown in sense of how many units of risk you would have to withstand this period with your position. Okay, so let's see the stats. Okay, so here is all the dates that since we have the data. So October 25, right? And these are RTH drawdowns in this period of time in the trade window 1. So you can see 1, it means that after the market open, it didn't fall more than the closest unit of risk. Okay, and this is important. So let me draw this. Let's say that the market opens here. Okay, and we want to trade long. So where is my unit of risk, or where would I put my stop? I would put my stop loss here, like 2 points. I usually use 2 points below the 1 unit of risk. So it's not like I'm measuring this, right? And I'm not going to put it here as my unit of risk. No, I treat these levels as my support resistance. I will get into the market above it, but my stop loss is going to be the closest unit of risk. Okay, so the closest unit of risk is this one right here, and I want to put my stop loss above if I'm using 1 unit of risk. Okay, let's have a different entry placement. Let's say that market opens here. Okay, let's say it opens here, right? So this is my long. This is where I open my long. Where is the closest unit of risk. Okay, the closest unit of risk, if the market opened here, and this is where I opened my long position, the closest unit of risk is this one. Right? This is the closest unit of risk. And where do I put my stop loss in this, bullish scenario? Here, 2 points below this. 1 or 2 points, something like that. Okay? Again, let's say that if the market opens here, where is the closest unit of risk? Well, it's over here. This is my closest unit of risk. So where do I put my stop? Well, just 2 points below it. So here is my entry. Here is my stop loss. Okay. Now, as to what would happen if I would use 2 units of risk? Well, it's easy, It's if I use 2 units of risk, this is my closest 2 units of risk. And where do I put my stop loss? Well, here, right? 2 points below my 2 units of risk. If I'm using 3 units, then this is my 3 units, and my stop loss goes here, right? Okay, so this is how we determine our stop loss. It's not the distance itself, it's also the placement. It's also the placement of these lines is important, because they will act as support and resistance. Okay. Now, if let's say there is a bearish scenario, right? So let's say this is red, the dealers are bearish, so we are trying to go with a short. So let's say that this is where market opens, okay, at 9:30. This is our open. So where is, for the short side, where is our closest unit of risk? Right? Well, this is our closest unit of risk. Right? So if we open here, this is our closest unit of risk because this is the first one above. And our stop loss just simply goes 2 points, about 2 points above this unit of risk, right? Again, if we are using 2 units of risk, right, then our stop goes here if the entry is here, right? Okay, so I hope this is very clear, and this is our entry, and this is how we place our stop loss in this basic strategy. Okay, this is, we don't look at anything else here in the basic strategy. Now, let's get back to the stats. So you can see what is the average drawdown during this period if you would enter at the very open or close to the the open. Okay. So basically, this is like we have the most of times we have 1 unit of risk, which is maximum drawdown. So it's 1 or more. 1 or less. So it's not more. It cannot be more or equal 1. If we have 1 here, it means that it was within this 1 unit of risk. If it's 2, it means that it was within 2 units of risk. It basically, it's telling you that this is how many units of risk was enough for the trade to be positive during this period of time. And we'll get to the period of time actually in a second, okay? So if we look at this, or we actually can, let's see the chart of this, okay? what is the so the average is 2 units. So this is the average. We have just 1, 2, 3. So the 3 units we would have to have 3 units of risk in 2 cases, and in 4, 5, and 5 cases, you would have to have like 7 units, which is actually the stop loss, because I would never go with 7 units of risk. Okay, so without any filters, based on almost 100 transactions, or almost 100 days, because here is only 65, but I have estimated about 20 more days. But let's say that it's like 70 days. So it's over 3 months of everyday transactions. Well, it's easy to nail the optimal number of units of risk that you should do. It's basically 2. So 2 units of risk is the optimum to withstand this time window and usually have profit. Okay. So in this basic approach, you will have fewer sells, like over here, the beginning of January were 3 SLs in a row, so 3 days with a sell. But again, this is without any filters, you don't look at any other sentiment metrics, anything else. This is only entry with and at whichever level, no matter how high or high low the market is, you just go with the dealer sentiment, okay? But you can clearly see that, it's almost 90% of days is positive. So you have, with 2 units of risk, you have almost 90% of accuracy. And you're trading practically every day, okay? So this is, for me, it's quite obvious that 2 units of risk is a optimal risk in sense of price range. Now the other part of this equation is, of course, the reward, right? And here is the interesting thing, because I'm still doing some research on this and gathering data and so on, and I encourage you to do the same. To gather data, because I will show you in a minute how to backtest this on your own, right? Because we actually have the documentation for these trades, because this is on the Substack. This is why I am, pasting these charts, to have access to it, because I'm more a visual person, and I really like to have not just the numbers, but I want to see the price action, where the levels were, how the indicators were lined up in any particular day, and yeah. So the other part of this equation is, of course, the reward. And the very interesting thing is that when you have just 1 unit of risk, usually it's about 50-50, you will have, this is RTH max. So what it means is that how many units of risk was to the upside on on that trade. So what was the maximum profit during, but not just during this time window, but until the end of the session. And you can see that, like, if the initial trade is within this 1 unit of risk, so there is, like here, there is not much of, drawdown here. Look, where is the max drawdown here is here. Like, this is the max drawdown. So it is definitely within 1 unit of risk, right? I mean, this is unit of risk here because this was open. Yeah, so let's go with this example here. So this is open, right? So where is the closest unit of risk if the open is here? Well, it's the closest unit of risk is this one, right? Because we are trading long, where do we, and let's say that we agree that the optimal unit of risk is actually 2 of them, right? So if we have 2 units of risk, let me do this right. So where are the closest to our entry, which is here? Let me erase this here. Where are the closest 2 units of risk? Well, it's these ones. 2 units of risk. So where do we put our stop? Well, we put 2 points below. Right? This is our trade entry, basically, and risk on this trade. Now, we can see that 5 minutes after 5 minutes after 5 minutes, we are within 1 unit of risk, actually, right? So we know that this trade is going pretty well, and we are from the start, we are within 1 unit of risk. And if we look at the stats, we know that there is a high correlation between initial 1 unit of risk, so initial drawdown within 1 unit of risk, and the max potential reward. So these are 7 units of risk reward, 7, 7, right? Now you can see that we have 2, so somewhere in the beginning the price was within 2 units of risk, and we immediately have just the max potential upside was just 2. Okay, and every time there is 1, well, not every time, but at least half of the time when we have 1 unit of risk as initial risk, that price doesn't go to to the area of the second risk unit, then there is a much higher probability that we are dealing with a trend day. Okay, so now you have to actually decide what's best for you, because it's kind of hard to at least for a lot of you, I know for a lot of you it will be hard to withstand let's say 6 or 7 units of risk in sense of profit, because these are usually trending days when you're eager to take your profits, right? So basically you have to decide based on the stats, if you want to have a bit more losses, but you're waiting, especially when the this opening range, let's say, is within 1 unit of risk, and the probability of the price going in one direction for the whole session is a bit higher, then you have to decide which one you go for. Well, personally, I have a mix of exits here. So I basically will use other levels. I will use other tools as my exit. I will also use other sentiment metrics. So I will use all sentiment metrics. But if we are talking about basic strategy, you want to do 2 things. So here's my proposition. So you can see that this time window consists of two time windows. So the first one, they both start obviously at 9:30, so with the market open, right? But they end about 11. So this is 1 hour and a half, and then there is one more hour. And this is for me a critical point in time. Okay? So if at about 11 a.m., okay, if I'm still in a position, if I didn't get SL, if I'm not stopped out, I'm in a position. If I am in profit here at 11, okay, this is very important for the second part of your trade, so the exit. If I am still in a trade and if I am profitable, I will definitely do something with the trade. And what I can do? Well, if I see that my during this first period, my risk, so max drawdown, was within 1 unit of risk, and I'm in profit, like here, then there is a high probability that this is not over, that this day can be a trending day. Okay. A lot of you were asking, how to gauge if we have, a trending day or something. Well, this is one of the ways to do it. You check your drawdown. You wait for about 11 a.m. New York time, and you want to see if you're in a hefty profit, and it will usually be, or not usually, but more times this is going to be a trending day, and you're in the right direction, right position. But what you want to do definitely is to put your stops to break even, just in case, because if it breaks down, then it means it was one of those days when when the probabilities were on your side, but that was this 30% of probability that is not going to happen. Okay, sometimes, and this is discretionary, I will be like tired after an hour and a half of being in that position. If I'm in a big position or something like that, and I'm just simply tired, I will get out close to this 11 a.m. If I'm in profit, obviously, right? I will get out. I won't wait for I will just take whatever market gave me until this, and I just want to be out, and I'm out, right? Because I know that the probability of this trade is on my side. I have like about 80% chances every day that it's going to be in profit within the risk parameters, so 2 units of risk. And if at this point I'm in profit, then I might just wind down and wind down the position, right? And take the profit and go to the next day. Okay. So this is one way to exit, and I'm not going to tell you when it is better to do this. It is, again, this is based on my personal feeling at this point in day. If whatever I want to do, like for example, if I know that. Okay, I know that I have bullish sentiment, dealers bullish sentiment, right? And I want to go long here with this basic strategy, okay? But I know that the sentiment is bearish, but maybe GX is also bearish. Then I will get out here. Because I know that there is a high risk that the market will reverse somewhere here or just after the end of trade window, that the market will reverse. So I will probably chicken out and get out here. Okay, that is that is something for sure I'm gonna do. But if you are positive that you don't see any other troubles ahead, like the sentiment adds up, the dealers adds up, the GX adds up, everything is in the right place, well that definitely gives you a bit more confidence. Okay, now this is simple example because you got in here, you had this 1 unit of risk, so the probability that it will go higher, even higher than this at 11 a.m. is quite significant, and it was an easy trade. What if we are within our drawdown, so we are still in the market, but we are slightly negative, right? Or close to our stop loss, and we are at 11 a.m. If this happens, so basically if we entered here and at 11 a.m. we are, let's say, here, right? This is our stop loss. I'm not moving stop loss, right? This is one thing that is for sure. You don't move your stop loss. Okay. Now, what do I do? Well, I still want to get out of it, but without profit. I want to get out of this trade with on a break even. So when I'm negative and it's close to 11 a.m., I want to get out of this trade. And usually during this period, this last period, you will get your option to get out. It might be 10-15 minutes before 11 a.m. and I will take it. If it gives me break even, okay, right? So you can see what I'm aiming here for. This is my the time window, like a proper time window for my trade with this basic strategy. Okay, if I'm underwater but still in position at about 11 a.m., I want to get out with break even, or I will be stopped out, right? Now, if I'm in profit, but not so big like this one, I might consider. So let's say we are, I don't know, maybe one unit of risk, right? Maybe I'm here, so small profit, right? Then I will definitely consider putting my stop loss to break even, so moving my stop loss to break even and let it go. And that would, in most cases, this is what I'm going to do, right? But this is the part which is kind of a discretionary for me, okay? And it really depends how you feel at the moment about the market. And again, this is connected to other sentiment metrics, to swing strategy that maybe I'm waiting for the short signal, like here. I was really hoping here that after the windows is closed, the trade window is closed, I want to look for short. So I definitely didn't want to be long anymore, right? Well, and we kind of got this short, but it was later on in the day, right? But I hope you get my point. So exit is sort of discretionary, but it has also some strict rules. But these rules are time-based, okay? So 11 a.m. when this lighter color ends is so it can be like 5:10 before 11 a.m. and I will start to considering exiting or moving my stop loss to break even, okay? And as I said, there is no wrong way. Whatever you will do, if you exit, fine, at 11. If you decide to hold, fine, right? You cannot go wrong with that. And there is, in my opinion, there is no need for a strict rule, because most of the time you should be in profit. And whatever you do, if you close here, okay, your risk reward will be lower if you won't hold through the trend days, okay? But I just told you when potentially there is more probability for these trend days, right? So if you remember, if we are at 11 a.m., if we are within 1 unit of risk, it's fine. It's the probability of a trend day rises. But even if you exit, there's nothing wrong with that, okay? Because the edge in this should make up for for this indecision here. I mean, you have to make a decision here, but there is no strict rule. Either you should hold or exit. Okay. Just one thing important, I think, is that if you have at 11 a.m., if you are in a drawdown, then I suggest that you try to get out of this trade. If you can before stop loss, okay, that's great. If not, then just to break even this, right? Or you can hold until the SL. I mean, you will still be positive after a week or two trading with this, if the stats and the edge in this strategy is going to persist, right? Because I don't know how long it will work like that. I think that it has a potential to be something structural and be something really consistent through a lot more time, But yeah, I mean, you never know. That is uncertainty that we are dealing with, right? I wrote about it, I wrote a tweet about it, because somebody asked, I wonder when it will stop working. Oh, I mean, it was for that swing strategy, but I wonder when it will stop working. Bro, this is basically the name of the game. If I would know when it will stop working, I would be like the richest man in the world, right? Because this is the name of the game. The uncertainty and dealing with it is actually what it's all about, right? So we find some kind of an edge historically, which works historically, but nobody knows if this edge is going to hold, for another week, month, or especially, based on the things like options data. Well, it's really dynamic and it changes a lot. But on the other hand, it probably will stabilize at some point. And, even with our cycles, right? We have 120 years of data and it works perfectly, like magically. Am I 100% sure that the next time the shift is projected to come and we projected it in the same way that we backtested it historically, the world changed in the same way, but is it going to happen again? I don't know. Because eventually, in the end, we don't know, what's around the corner, right? Until it happens, we don't know, So this is my best guess of what can happen. That's your edge. This is your edge. Edge is not. I mean, this kind of edge is not something 100% sure. But again, that's the name of the game. Okay, I think that covers the basic strategy, and then in next videos, I will add layers upon this. Well, the layers which are based mostly on the other tools. Okay, so we will build something which is probably a bit more robust until we get into the swing strategy, or maybe the next video is going to be about the swing strategy, because the direction of the swing strategy for each day is actually adding some information to our trade, which we might take or we might not take, just because this what the swing strategy tells us, right? So I'm not yet sure if we'll start with adding layers, or and if the first layer is going to be actually the swing strategy, which will also affect the this basic intraday strategy based on automatic trading plan study. Okay, so I think this is that's it for the first introduction to the strategy, and to this very basic but I think very effective strategy, which I like a lot because there is no confusion, right? If we are above the level, if we are below the level, if if this or that filter is in or not. No, this is wherever you are at 9:30. Just go with the dealers, with the momentum, and act upon it, and focus on an hour and a half or even 1 hour of this first trading hour, and just monitor the outcome, right? Oh, one more thing I've got to add. How do you backtest this? I'll give you an example of how to backtest this. Okay, so you go to archive, go to any day in the past, and you go to the post structure post. Okay, so let's say we have January 22 structure plus overnight buys. Okay, and what we have here are these two charts. The dealers, okay, and the structural levels. Okay, so let's go first to dealers. And in dealers, you check the very beginning of this lower panel. And if you see that the violet line, so our the dealer's sentiment line is above 0, then you know that we will trade long, right? So you check the beginning of it, because this chart is after, this is updated after January 22. So at the end of the day on January 22, I update all the charts. Okay, so if you want to backtest that day, according to the basic strategy, you want to check what was the dealers at the very beginning of this chart. So it was above 0, so it was bullish. And then you go to the chart structural levels. Okay, this is the beginning of session. The first line, that yellowish brownish line here. This is 9:30. You can see the open was here, right? So if you were to have 2 units of risk, where is the closest unit of risk? Like 1, 2. So this was your stop. You entered here. This is 11, somewhere here, right? Or somewhere here, something like this, right? Oh no, this half of this is so 9, 10, 11. So 11 is here. So this is 11. Right, so this is how you can backtest this. Okay, so you had about 2 units of risk to the upside, and like 1 unit of risk definitely within 2 units of risk until 11 a.m. and it was like a break-even trade. So if you were, let's say it was 10:30, and this was your entry here, so you had couple times it hit your break even, right? Even later on. So there was nothing really going on. Let's say let's go day before. I don't know, like the session before was 19 January 19 structure. Okay, so first you want to see the gray line is a 0 line, right? The gray line. So the the dealer's bias was above 0, right? So bullish. So this is how you backtest this, right? Okay, so this is the 930. So this was open. Where is the closest risk unit? It's this one. The second one is here. So you can see that 11 a.m. was here, somewhere here. So at 11 a.m. we were within 1 unit of risk. So we have high probability of market going up all day. So a trend up day, right? And this is basically how you backtest. Like this is what I showed you, right? So you enter here, right? Here is your stop, 2 points below this second unit of risk. At 11 a.m. somewhere here, you are in profit, okay? And you might want to put it into the at 11, so somewhere here you want to put it in break even, right? And you decide you want to get out here. You can see that this is actually the local top. That is why 11 a.m. and about like 10:45 until 11 a.m. is well known for like a reversal time of the day, somewhere around this, and you actually have a local top. But because we know that we are in this potentially higher probability trending day, then you might want to consider, okay, let's put it to break even, so we are not going to lose money on that day, but we might have some more units of risk in our favor. So this is like 1 unit of risk profit here, 2, 3, 4, 5, 6, 7, probably about 8 units of risk. So we risked 2 initially, then we moved to 1 or to 0 actually, and the market moved 8 units of risk up. So it was actually the 1 to 4 risk reward trade, which is for intraday trading, I think it's very reasonable. I mean, it's very good actually. So yeah, this is how you can backtest all these things. And again, the violet line on Substack is until October 25, I think, something like that. You gotta scroll down and see. Okay, so this is my first video on strategy, the very basic strategy, and in the next video I'm going to show you a bit more about the basic swing trading concept, which I think is even more exciting than not even more. It's definitely even more exciting for me. Exciting than this intraday concept. But I'll talk about it in the next video. Okay, thank you, and see you in the next one.